Good afternoon. Happy Friday, January 24th. Mark Milam here, your mortgage professional. Mortgage rates finishing out the week, kind of how we started. It's been a light week from an economic data standpoint. We really just haven't seen a lot to move the needle back and forth. That's kind of welcome after last week. We saw a lot of industry upset last week. Though we finished out the week on a positive note, this week has been much calmer. One thing we did get this week, of course, was the inauguration of the new president of the United States and the executive orders that came with it. Flipping the screen around here, this is one of the executive orders as it pertains to housing, and it's basically declaring emergency price relief for American families. This is an executive order signed by President Donald Trump. If you scroll down to the bottom, this is where it kind of gets into housing, and these are really broad statements. So he's ordering the heads of all executive departments and agencies to deliver emergency price relief consistent with applicable law to the American people. This shall include lowering the cost of housing and expanding housing supply, eliminating unnecessary administrative expenses and rent-seeking practices that increase health care costs, and then eliminating counterproductive requirements that raise costs on home appliances. They want to create opportunities for American workers. Eliminate harmful climate policies that increase the cost of food and fuel, and he wants it all done within 30 days, but sort of light on the specifics as to how exactly we're going to make housing more affordable. Listen, there are only so many levers you can pull. You can't really go out there and issue a presidential declaration to lower an interest rate. The mortgage rates are not something that are directly controlled by the president or the Federal Reserve. Those are market-driven rates, not like the Fed funds rate where you can set it and forget it. These market-driven rates are not dictated by any one entity, and they're certainly not dictated by the President of the United States. Same things as it pertains to housing supply. I understand the goal here is to make it less expensive to build a house, but that doesn't mean that you can force builders to build. Builders are already starting to sit on a growing pile of inventory. We're seeing a lot of inventory starting to build with new construction. And the last thing the builders want to do, listen, these are motivated sellers, builders are. The last thing they want to do is start building into excess supply that might force them to lower prices below the point at which they can make a profit. And if we're talking about, well, we're going to lower the cost to build so we can make housing more affordable, that's not working out too well as it pertains to the NAR lawsuit. You know, the big promise of the NAR lawsuit and pushing commissions for a buyer off to the actual buyer of the property versus building it in from the seller was that home prices were supposed to come down, right? That was the whole sell to potential home buyers, is that housing would get more affordable because sellers wouldn't be building in this extra 3% to pay for buyer's agent commissions. Well, that hasn't necessarily translated either. We've seen housing prices set new records as recently as Q4 of 2024. That hasn't really played out. We're not really passing that savings along to consumers and making housing more affordable. So what levers can we pull? If we can't really change interest rates, we can't really force builders to build and necessarily force builders to pass a reduced cost to build onto potential buyers, what levers can we pull? And this is where it gets interesting. So, and a little hopeful. So I'm going to switch over here to a piece of legislation that was introduced on December the 19th, a bipartisan bill from a Democrat and a Republican, which is the Mortgage Insurance Freedom Act. So basically what this is stating is that the mortgage insurance associated with the Federal Housing Administration loans would now be cancelable once equity in the property reaches 22%. Right now, anytime you have over 90% financing on an FHA loan, that mortgage insurance is there for the life of the loan. It cannot be eliminated through an equity position, through paying down your mortgage or through home appreciation. And what these gentlemen are proposing is that, yes, it could be eliminated. And I think that goes to an even larger point. Hey, this is a move we can make to have housing be more affordable. We can focus in on the Federal Housing Administration. And I'm going to switch back, flip my screen back around and show you one more thing. These are the annual FHA mortgage insurance premiums as they have progressed since the year 2000. It used to be about 50 basis points. This is the annual gets divided by 12, and it's what borrowers pay monthly as part of their monthly payment with an FHA loan. And you can see how much it went up here during the Great Recession. All of the short sales and foreclosures and FHA needing to recapitalize, they raised this annual FHA mortgage insurance premium. Right here in 2013 is where the mortgage insurance premium hit its peak at 135 basis points. And then it also became a life of loan mortgage insurance. So in other words, not cancelable any longer if you're over 90% financing. It was lowered to 85 basis points in 2015, and then in 2023 it was lowered to 55 basis points. And that lowering in 2023, along with the Federal Housing Finance Agency worsening loan level price adjustments for many of the conforming conventional loans, saw FHA pick up a lot of traction over the past couple of years. In fact, we're seeing FHA now almost 1/3 of all mortgage transactions, purchase transactions, are now FHA loans. Flip the screen back around here and just show you a little bit more. This is the MMI fund. So when you talk about PMI, that's associated with a conforming conventional loan. FHA has mutual mortgage insurance. And the mandate from Congress is that the capital ratio here is at least 2%, right? That's what Congress wants to see, is a 2% capital ratio in this fund. And you can see what's happened over the years. We're now 5 times higher what the congressional mandate is for the mutual mortgage insurance capital ratio. That's great news. That means FHA is extremely well capitalized. And we can see how the FHA share of new home purchases has increased as we've moved post-pandemic through the end of 2024. So all this begs the question, perhaps it is time that we remove the life of loan requirement for FHA mortgage insurance, but even more importantly, perhaps it's time that we shave that 55 basis points down even further, maybe back down to 50, maybe even sub 50, and make FHA loans more affordable for everyone. This is going to be fascinating to watch. It's one of the levers that we can pull to make housing more affordable, and hopefully we're going to see it come to pass in the year 2025. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.